Now, a lot of the financing that was done in the last 10 years was mezzanine type financing, where instead of having a lien on the actual property, you'd have a first mortgage on the property, and then you could have an LLC that owned the property and another LLC that owned an interest in the owner of the property, and you'd have debt that was secured by that LLC interest that owned the property. And you could have layers of mezzanine debts all the way up the chain, each sort of with less security than the one ahead of it. But the common thing among all of them was that they weren't secured by the property, they were secured by interests in the entities that had a direct or indirect ownership in the property.
Right.
What is the transfer tax implication of exercising on that collateral? Because that's not literally a foreclosure, it's a UCC sale, which is sort of like a foreclosure, but it's not literally a foreclosure. And I think in the market now, that's a lot of what's going on. You know, in the environment we're in, maybe not as many buildings are actually trading as the mortgages and mezzanine debts that encumber those buildings, because that seems to be what's for sale to some extent. What are the implications of buying debt like that and having to execute a transaction like that?
So the foreclosure of mezzanine debt has a lot of similarities with the regular transfer tax with regard to the regular foreclosure process. Unfortunately, a lot of the time when you actually have a foreclosure on the mezzanine debt, there's underlying mortgage debt as well. So your consideration is going to be whatever the bid is, the winning bid for the actual mezzanine foreclosure. And to the extent any other liens which are secured by the property are not extinguished, which presumably they wouldn't be with the mezz, that will also be added to your consideration. So it can be a pretty expensive transfer tax consequence for that as well. There are some variations between the city and the state, but it's going to be a big transfer tax bill no matter what.
To sort of pick up on our prior example, if we had a $100 million first mortgage, and then a $100 million mezzanine that was secured by an interest in the borrower, and the property was now worth $110 million, let's say. So someone paid $10 million for the mezzanine piece and then opted to foreclose on the collateral. The transfer tax would be on $110 million, the consideration paid for the mezz, plus the $100 million first mortgage.
That would be the result for New York City. New York State, assuming the actual bidder was the lender, has a slightly friendlier outcome. They may actually limit the consideration to the fair market value of the property.
But New York State is the smallest part of the tax, so
exactly.
A big, even if you got a little break on that, you're still looking at a multi-million-dollar tax
exactly
on a transaction where if you paid $10 million for the lien, 25% more of the cost is going to be attributable to a transaction cost.
Correct.
So that's a pretty expensive cost, and the key here, or one of the keys at least, is you're buying a controlling interest in the property, because New York, even though those are typically disregarded entities because they're single member LLCs, which are disregarded for income tax purposes, the state and the city view those as legal entities. And when you buy 100% of that interest, it's a controlling interest for transfer tax purposes.
That's correct.
So that's a pretty big shock for people, and I think it's pretty typical among investors out there, even sophisticated ones, that they're not really thinking about that cost involved when they're thinking about buying these liens and transacting and taking over some of these properties. It's just not something that people have underwritten as part of their cost of doing these things.
Absolutely not. How many times have you taken a phone call from someone where they're buying a debt for pennies on the dollar, they plan to actually take ownership of the property, and they find out later that it's going to be much more expensive than they originally thought?
It absolutely comes as a surprise to many people, something that absolutely has to be factored into these things. So I think one of the key things we want people to walk away from here is that these are complicated issues that are frequently overlooked when people are thinking about distressed assets and workouts and things like that. They absolutely have to be considered so they don't sneak up to people and become, multi-million-dollar issues at the 11th hour. And one of the things people try to do to solve for some of this stuff is to play with the note balances and maybe reduce the note balance to have a smaller transfer tax, but that can have some pretty pernicious income tax effects as well. So you can't solve for one without making sure you've accounted for the other one along the way.
That's definitely true.